This is Nightly Business Report with Sue Herrera and Bill Griffin.
This new deal will be the most modern, up-to-date, and balanced trade agreement in the history of our country.
A new NAFTA. The U.S. reaches a deal with Canada, alleviating investor fears over global trade.
C-suite shakeup, from the surprise exit of GE's CEO to the orderly transition at Goldman Sachs. Some of the biggest companies in the world are ushering in new eras.
Attacking cancer. The Nobel Prize in Medicine is awarded for work in one of the fastest growing segments of the biotech industry. Those stories and much more tonight on Nightly Business Report for this Monday, October 1st.
And good evening, everybody, and welcome. The first day of the fourth quarter started with some big gains for blue chips. Concerns about global trade were put on the back burner when the U.S. struck an 11th hour deal with Canada on a revamped trade deal. That agreement scraps the NAFTA name and was inked just before midnight, with just enough time to get it signed before the newly elected Mexican president takes office. The Dow Jones Industrial Average advanced 192 points to 26,651. The Nasdaq fell 9, and the S&P 500 was up 10. Ilan Mui has more on the trade deal that put investors in a buying mood.
President Trump took a victory lap in the Rose Garden to tout this new deal. No longer NAFTA, but the USMCA, and his use of tariffs to force countries to the table.
Without tariffs, we wouldn't be talking about a deal. Just for those babies out there that keep talking about tariffs. That includes Congress. Oh, please don't charge tariffs.
The agreement opens up a slice of Canada's dairy market to the U.S. and removes barriers to trade on cheese, yogurt, and ice cream. It also boosts the amount of North American components in cars to 75% and requires that some of those workers must be paid an average of at least $16 an hour. It also modernizes the agreement that took effect about 25 years ago, before the advent of the digital economy, giving pharmaceutical companies exclusive marketing rights on biologic drugs for 10 years and banning duties on ebooks, music, video, and software. Not a part of this new agreement, steel and aluminum tariffs. Those remain in place, but are being negotiated. And the deal ends the uncertainty that President Trump would slap tariffs on auto imports.
What we were able to negotiate with the Americans on this is protection for the Canadian auto industry and auto parts industry from 232 measures on autos that the president might move forward with.
Mexico and Canada have a 60-day window to negotiate with the U.S. if the president were to slap tariffs on autos. But the threat is much lower as the new trade agreement moves into the next phase, getting signed and through Congress. I'm Ilan Mui for Nightly Business Report.
In response to the trade deal, automakers saw their stocks rise, as did railroad shares, on the idea that goods will be able to freely flow between countries without tariffs.
Well, as we said, today saw some big changes in the C-suite of some very big companies. We start with Dow component Pfizer, where CEO Ian Read will step down in January and hand over the reins of the largest U.S. drug maker to Albert Bourla, who was appointed chief operating officer at that company at the start of the year. Prior to that, he led Pfizer's innovative health business. Read joined Pfizer way back in 1978. He'd been CEO for the past 8 years. During his tenure, the company won 30 drug approvals, but also failed to close 2 high-profile deals. On that news, the stock rose a fraction in today's trade.
Fellow Dow component Goldman Sachs also has a new executive in the corner office. David Solomon today took over for Lloyd Blankfein, who has served as CEO since 2006 and will stay on as chairman. One of the biggest challenges facing Solomon is finding ways to increase revenue. The shares rose a fraction on Solomon's first day as CEO.
And now to former Dow component General Electric, which stunned Wall Street and investors first thing this morning with news of the sudden departure of CEO John Flannery. The reason? Missed targets and the realization that problems at its power business would hit profits and cash flow for this whole year. But investors cheered the move and the man replacing Flannery, the former CEO of Danaher, Larry Culp. The CEO, Larry Culp, may be new, but GE is facing a lot of familiar problems. Like Jack Welch and Jeff Immelt before him, John Flannery was a company veteran, having spent 30 years at GE. But his 13-month run as CEO saw GE's stock price decline by half. Culp is the first outsider to take over at GE in its 126-year history. He came to GE's board in April. Culp ran Danaher, a maker of dental and life sciences and diagnostic equipment, for 14 years. And with him in charge, Danaher's stock gained more than 460%, more than 4 times the S&P's 105% gain over the same period. Even with GE's poor performance this year, it's a stunning and unexpected move.
The people that are there are some of the very best people in the world in engineering, science, and math. This is a jolt to them now. They're going to need to be feeling that they're valued, very valued, and that they're not going to be, taken advantage of in any way for quick decisions.
And quick decisions may be in order. Today's move comes with news that GE is also taking a $23 billion write-down in its power unit, a division that includes France's Alstom. Acquired by Immelt in 2015, it's a move that has backfired as global demand for power generation fell. GE also plans to shrink its healthcare manufacturing business further, and question marks remain about its stake in Baker Hughes, an oilfield services company.
If you're buying the stock today, you're buying hope. Exactly that. GE has been overpromising and undelivering for quite some time.
And there are renewed doubts about GE's once vaunted dividend, which was cut in half a year ago. Just where GE is heading and what a new GE will look like are questions that continue to linger.
It was clearly not communicating well to the market. And also, what was the clear vision of who the new GE is going to be? I don't think that was that clear to everybody. So that's part of it. But I do think that it's a huge disappointment, of course, to investors, and you can't deny that. How long do you let somebody twist on the vine? But 13 months is a pretty short window.
Well, let's turn now to Joshua Aguilar for more on the management shakeup at GE and what he thinks it means for the stock. He is an equity research analyst over at Morningstar. Welcome. Nice to have you here.
Thank you so much for having me. I really appreciate it.
In reading your report, you're kind of cautiously optimistic. You approve of Mr. Culp going in. But what does the timing of this all mean to you?
Yeah, you're correct. I mean, Culp, we think, is the right man for the job. I think the timing was simply that the board was frustrated with the pace of progress. So, they're basically sending out a signal to the market that everybody is accountable, even the CEO.
What's the biggest issue Larry Culp faces right now, and how long do you think it takes to fix?
There are 2 big issues right now. GE Power, they're going to have to continue with the cost out. So I think one of the things that they need to do is have a conversation with Russell Stokes and say, where is some redundant footprint? Where are the extra expenses, and how do we become much more efficient? And then the second portion is GE Capital, and how do we get rid of some of the liabilities off the books?
A lot of people bought GE in the past for the dividend. It has been cut. Do you think the rest of that dividend is safe or not?
Even with the separations, because healthcare companies pay out less than industrial companies, the aggregate dividend would be cut even if Flannery was still in place. So no, it's not safe.
The plan as it stands now is to spin GE Healthcare off. Do you think that is still in the works, or is everything on the table right now?
I think, generally speaking, the idea of keeping aviation, power, renewables is probably what they're going to stick to. That being said, the particulars and how they execute that plan it might be odd. So, for example, GCAS, that's been rumored that is going to be on the block. If they can do a composite deal where they get rid of GCAS and get rid of some of the liabilities on there, even though GCAS is a really good business and it's aviation, that's still a possibility. And that, that again goes along with aviation.
Very quickly, if you're an investor with a long-term time horizon, what do you do? Is this an entry point in the stock, or do you think it needs to go lower?
I think right now at our 4-star, we're saying it can be better than the market. But at a 5-star price, which is where we kind of pound the table, it's $9.42. And that's what we're saying is you would be getting aviation, healthcare, and that's what you'd be paying for. If you attach all the liabilities, you'd be getting the rest of the businesses for free. So we think it's an attractive asset play. But at the same time, it's not a pound of table bargain for us right now this time.
All right. Joshua, thank you so much. Joshua Aguilar with Morningstar.
Elsewhere, shares of Tesla surged more than 17% today. Over the weekend, CEO Elon Musk agreed to settle with the SEC over allegations of making false and misleading statements that affected Tesla's stock. Late last week, you might remember that Musk rejected a proposed settlement and vowed to fight the federal government. But as our Phil LeBeau reports right now, Musk is now dropping that fight and agreeing to changes at his company.
Tesla CEO Elon Musk has decided it's better to settle with the SEC than to spend months in court and risk getting banned from being CEO of his auto company. Instead, Musk will give up being chairman of Tesla for at least 3 years, and the automaker has to add 2 new independent directors. In addition, both Musk and Tesla will pay $20 million fines, and the company must ensure there is oversight of Musk's communications. That includes what he puts on Twitter. So Tesla will now be expected to keep Musk's tweets in check.
I think that he may be tweeting as much, but what they're trying to do is to make sure that there is oversight of substantive tweets.
With the SEC investigation over, Tesla and Musk can focus on 3 key issues. First, growing Model 3 deliveries to meet lofty expectations. Second, can Tesla finally turn a profit, as Musk has promised? Finally, will Tesla need to raise more money as it expands operations? Analysts believe Tesla can clear those hurdles with Musk remaining in charge of the company.
Having him remain CEO is critical because the company essentially is at war right now. War in terms of getting to profitability and producing Model 3s at a scalable rate.
If Tesla can successfully ramp up production and sales, it could be on the cusp of sustained profitability. Yet one more reason Elon Musk's settlement with the SEC is critical to the automaker's future. Phil LeBeau, Nightly Business Report, Chicago.
It is time to take a look at some of today's upgrades and downgrades. Intel was downgraded to underweight from equal weight at Barclays. The analyst cites the risk of a price war with its rival AMD. The price target is $38. The stock fell more than 1.5% to $46.45. Chipotle was downgraded to underperform from perform at Oppenheimer. The analyst says Wall Street is too optimistic about the company's earnings. The price target is $400. The stock fell more than 1% to $446.97.
Meanwhile, UPS was upgraded to outperform from market perform at BMO Capital. The analyst cited the prospect for improved margins at the company. Price target now $128. The stock rose a fraction to $117.46 today. Teva was upgraded to market perform from underperform at Leerink Partners. The analyst cited Teva's improving fundamentals. Price target now $24, but that stock fell a fraction today to $21.46.
Still ahead as we enter the final stretch of the year, will the rally in tech stocks heat up or start to cool down?
The price of oil hit its highest level in 4 years today, in part because sanctions on Iran are starting to shrink the world's supply. Prices also rallied on the trade deal between the U.S. and Canada. The trade dispute had raised fears of a slowdown in growth that could impact oil demand. So prices in domestic crude settled above $75 a barrel today.
The Trump administration is close to finalizing a measure that would ban bump stocks. Bump stocks are devices that allow semi-automatic weapons to fire like a machine gun. Those comments sent shares of the gun makers lower, including American Outdoor, Stromberger, and Vista Outdoor.
The fourth quarter is typically the strongest of the year for the broader stock market, and so far, the tech sector has been the best performing group of this market in 2018. But what happens when the two go in opposite directions? Josh Lipton takes a look at what lies ahead for that sector.
The hottest sector so far this year could stay that way, even after an 8% gain in the third quarter. Since 1989, the tech sector of the S&P 500, on average, has risen more than 6% in the fourth quarter, and it's been up almost 80% of the time. That's the strongest performance of any sector in the index.
I think it's because of two things. One, something called budget flush, where if you don't spend it, you'll lose it next year's budget. And second, the holiday spending. Let's buy all the latest gadgets for the upcoming holiday season.
But some of the fastest growing tech stocks aren't tech stocks anymore. Facebook, Alphabet, and Netflix have been moved to a new communications services sector by S&P. So tech investors will have to rely on the tech companies that remain in the sector, Apple, Microsoft, and Cisco, for growth. Still, bulls remain confident. They argue that tech will show relatively strong earnings growth of about 11% and revenue growth of more than 8% in the year ahead. Stovall says there are risks that investors should keep in mind, specifically whether companies really report the earnings growth that's expected. He says that could be impacted by tariffs on imports from China and Chinese retaliatory tariffs on U.S. exports. Chipmaker Micron recently said the combination could reduce its gross margins by more than 1%. Despite these risks, many say the tech momentum can continue. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Cal-Maine Foods lowers its dividend, and that's where we begin tonight's market focus. The egg producer announced the cut after it reported a weaker than expected return to profit and disappointing sales. The company also warned that an expected increase in shell egg supply could cause pricing pressures, and that news sent the shares of Cal-Maine lower by nearly 7% to $45 even. Online deals website Groupon has agreed to pay IBM nearly $60 million to settle claims that it used the computer maker's patented e-commerce technology without permission. The new settlement also includes a long-term patent cross-license agreement between the two companies. Shares of Groupon rose more than 2% to $3.87. Meanwhile, IBM shares were higher by 1% to $153 even. And after the bell, the online shopping service Stitch Fix said it added fewer than expected subscribers in its latest quarter, which resulted in a revenue miss. The company did, however, top earnings expectations, but shares were initially lower in the after hours, although they did end the regular day up nearly 2% to $44.63.
A Delaware court has ruled that a German medical supplies company can walk away from its proposed $4 billion acquisition of Acorn Pharmaceuticals. Back in April, this company from Germany, Fresenius Kabi, ended the merger with Acorn because it said Acorn failed to fulfill several conditions of the deal. Acorn says it's planning an appeal of this court decision. But meantime, the market spoke today. Acorn plunged 58% to $5.36. And small-cap drug maker Omeros released what it called positive findings in a trial of its experimental treatment of a progressive kidney disease. However, it was later revealed that the trial patients who received that drug had essentially the same result as patients who received a placebo. So shares were punished, falling by 42% today to $13.96.
The Nobel Prize in Medicine was awarded to two cancer immunotherapy researchers. Immunotherapy unleashes the body's immune system to attack the disease and is considered a breakthrough in cancer treatment. The award was a surprise to researcher James Allison.
After many years of resistance, I think the world, the cancer field has begun to accept immunotherapy now as the fourth pillar, along with radiation, surgery, and chemotherapy, of cancer therapy.
The other winner is based in Japan.
Certainly, immunotherapy is one of the fastest growing segments in the biotech industry, and until this breakthrough, cancer treatment mainly consisted of surgery, radiation, and chemo. Vamil Devan is senior analyst at Credit Suisse. He joins us now to talk about this growing market. This has been a game changer, I know, in the fight against cancer. How big is this market, and how big is it going to become, do you think?
Yeah, thanks so much for having me. Very, very interesting topic. I think if you look at the numbers for this year, there's really three main immunotherapies on the market right now. When we think about Keytruda from Merck and Bristol Myers has Opdivo and Yervoy, they're going to make about $15 billion in combined sales this year. We do estimate that the entire immunotherapy market could be as big as $40 billion or more if you look out 5, 6, 7 years from now. But it is still very much the early days and a lot of opportunity for this to expand into a lot of other tumor types.
You point out that it's already being used in people with melanoma, kidney cancer, but lung cancer, you think, provides perhaps one of the biggest markets.
Yeah, from a commercial perspective, I think that is correct. I think we've seen maybe more dramatic scientific advances in other tumor types, but lung cancer being such a common cancer, usually diagnosed when it's advanced or metastatic, so it can't be easily treated with surgery, lends itself to potentially chemotherapy, radiation, or as now with immunotherapies. So huge market opportunity, and we've seen some very impressive data over the last couple of years for using this as a first-line treatment. So as soon as people are diagnosed, getting them on these therapies, and where otherwise it was almost a death sentence, seeing people living for many years now with the condition.
You mentioned some of the drugs and the companies that make them earlier, but I'm curious for people watching saying maybe, I'd like to invest in companies that can benefit from immunotherapy. What do you tell them?
Yeah, guys, I kind of go back to it is still early days, so we'll see how things play out. Certainly the leaders right now on the large side are Merck, Bristol Myers right up there with them, and then other companies include AstraZeneca, Roche, Pfizer, Merck, German Merck, Merck KGaA. So there's a number of companies trying to get into the space. Merck and Bristol are in a pretty strong position, especially in some of these lead indications. But it's really, I think, a portfolio approach right now where you can buy a bunch of these companies, or certainly there's dozens and dozens of smaller companies that may have one product with one mechanism, and if it works, it could be a very meaningful investment. But tough to say that there's one approach that's going to be the end-all, be-all here, because it is still fairly early, but a lot of opportunity ahead of us.
It's very promising, that's for sure. Vamil Devan, good to see you. Thanks for joining us tonight. Appreciate it.
Yeah, thank you so much.
And coming up, the growing scrutiny on the advertising industry.
Here's a look at what to watch for tomorrow. A look at how automakers fared last month with the release of September car sales. A number of Fed officials, including the chair, Jerome Powell, will make comments on the economy. And PepsiCo will release its last quarterly earnings report under outgoing CEO Indra Nooyi. And that's what to watch for on Tuesday.
In other news, California has become the first state now to require publicly traded companies to include women on their boards. This new measure calls for at least one female director on the board of California-based firms by the end of next year. By 2021, companies would need to have 3 female directors, depending on the number of seats. Governor Jerry Brown acknowledged that the law may raise legal issues, but he said it's a good first step.
Facebook faces a potential $1.6 billion fine in Europe over its recently disclosed data breach. Regulators are looking to see whether Facebook violated the bloc's new privacy law and have asked the company for more information about the scale of the attack. As we reported, Facebook said hackers compromised the accounts of more than 50 million users.
And that cyber breach was one of the issues raised during this year's Ad Week. The annual event comes at a time when content publishers like Facebook and Twitter face growing scrutiny, and they're competing against new players for ad dollars. Julia Borston reports for us tonight.
Here at Advertising Week, Facebook's ad chief, Carolyn Everson, addressed the hack that affected 50 million users' accounts, telling advertisers and brands they're doing everything they can to protect users. The CEO of one of the world's largest ad conglomerates, IPG, parent of McCann and Magna, among others, saying they're watching how Facebook handles these issues.
I think Facebook will fix this. It's a vulnerability that they have to address. It's an embarrassment. There's no question about it. And frankly, if they don't fix it, then I will see a reduction in spend.
Ad consultancy MediaLink's clients, some of the biggest brands in the world, are watching the drip of news around Facebook's challenges as well.
It is having impact, and advertisers have reason for pause at this moment to say, I need to make certain the information is right, the data is correct, we're not being subject to breach. All of those things will have impact.
In addition to Facebook and Google, which dominate the digital ad market, there are more options for brands. Out in force here at Adweek, AT&T's new ad tech division, Xandr, here showcasing its reach and capabilities. And in contrast to Facebook's challenges, the brand's safety of its premium content.
There's also a lot of talk here about Amazon, a rising superpower in the advertising market, projected to become the third largest player in the U.S. digital ad market this year, enabling brands to reach consumers when they're already interested in making a purchase.
A significant part of e-commerce searches start with Amazon. So therefore, by definition, they're a force that you have to deal with. I think they will be a threat in terms of the reach and the target marketing that reflects the environment that we're in now, using data to reach those consumers.
All this comes as the ad agencies reportedly face investigation into whether they're receiving perks they're not passing along to clients. IPG CEO Michael Roth saying no comment, but that they've structured their business so they don't have any of these issues. Still, MediaLink's Casson says this added scrutiny couldn't come at a worse time for the agency holding companies.
I just think it's the model that needs to be more agile, more willing to be flexible, and understanding that there's a challenge not only from that, and certainly the FBI announcement of last week certainly ruffled a couple of feathers.
With more ability to buy and target ads with automated ad tools, the folks here are trying to adapt to a world where data is the increasingly important way to reach consumers, and protecting user data is more important than ever. For Nightly Business Report, I'm Julia Borston at Adweek in New York.
And before we go, here's a look at the final numbers from Wall Street. The Dow advanced 192 points. The Nasdaq fell 9. The S&P 500 was up 10. Happy October.
Here we are. Pumpkin time.
Pumpkin time, exactly. That'll do it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a wonderful evening. We'll see you tomorrow.